All right, enough about me. Let's talk about some of our clients, specifically those who have used their life insurance policies to buy real estate. We'll start with Mazen and Rasse, who I really like a lot. They're two doctors, they're a married couple who own a successful practice in Naples, Florida. Now, when I connected with them, they wanted to transition out of running their medical practice and into full-time real estate. The main reason why is because the husband in particular, Mazen, had a very demanding schedule and it took up a lot of his time. So they had a goal by about the age of 50 to transition into real estate full-time. So to attain that goal or help attain that goal, they each opened a policy where they put away $100,000 per year. While the policies are primarily purposed for real estate, they've been using them for their business. So they don't have restrictions as to what they have to use their policies for. So they've been using it for their business, which has been pretty cool to see. Next, we've got Tom. Tom owns a $60 million real estate portfolio. Now, he has multiple policies and he uses the cash value as a business line of credit for property improvements and also new purchases. Earlier this year, just a few months ago, he borrowed more than $1 million from one of his policies for a multifamily deal. He was earning 5% on his cash value before he borrowed that $1 million. 5% consistently. After he borrowed that $1 million, he still earned 5% on it. While at the same time, he used it for a multifamily deal, which is also producing him a return. He also gets to pay that loan back however he wants, instead of a bank telling him he must pay it back on a certain schedule. Then we've got Max, my good friend Max. Max invests in commercial real estate. His story was a couple of years ago for one of his commercial properties, the bank said to him, hey, we're going to cut your line of credit in half because the market has changed. It's like, what? I'm perfect with my payments. I've got healthy equity here. What are you talking about? The market has changed. Cut in half. So he does it himself now. So he's built up some very large policies over the years. Anytime he needs a loan, he typically gets it in 2 to 3 business days, and he doesn't have to deal with banks anymore. Now, to use life insurance policies for commercial real estate deals, he's funding them aggressively, his policies that is, at about $600,000 per year. But his minimum commitment is about $60,000. We'll go over how that works a little bit later. Let's talk about the core benefits of the cash value of a whole life insurance policy. Safety, liquidity, and the tax-free benefit. Before I jump into that though, let's begin with the basics. If you're new to whole life insurance, we're going to go through these 3 different colors. We'll start with blue, the death benefit. With a whole life insurance policy, you will always have a death benefit. This is the actual insurance on your life that is paid out if you die. If you have a policy on your spouse or someone else, the death benefit is paid out when they die, when the insured passes. Now, what you'll notice is that the death benefit will gradually increase over time with the whole life insurance policy. And when we do eventually pass, it is paid 100% income tax-free to whoever our beneficiaries are, whether it's our family, a trust, our business, or a combination of all 3. Then we have our premium and PUA rider. We'll explain these terms later. They both represent money you deposit into a whole life insurance policy. Question, with a whole life insurance product, do you think you have to pay premiums for your whole life? You don't. I'll show you some examples in a little bit. And then we've got the cash value, which you'll notice with that green line, it goes nowhere but up. And people who have owned whole life insurance through 2008, their value went nowhere but up. Early 2020, when the market crashed, when COVID first hit, their value went nowhere but up. Regardless of what is going on in the stock market or economy, I'll see my value go nowhere but up if I set it up correctly. So here's what is attractive about the cash value of a whole life insurance policy. First, it's a safe place you can put money. So what does this mean? First, your money is not invested in the stock market. You'll see guaranteed cash value interest rates, often between 2 and 4.5%. However, when I look at the net growth rate of a life insurance policy, it usually falls somewhere between 4 and 5% annually. Sometimes it's a little bit stronger. You're going to see a real policy that's producing a higher return than that. But to set expectations conservatively, I would say somewhere between 4 to 5%. It's liquid. You can access your money anytime. It can be as early as 10 business days after starting the policy. And here's why a lot of real estate investors and business owners are attracted to it. Your money keeps on compounding when you access it. And then the third reason why so many people are interested in this product is tax-free if we follow IRS rules, which is very easy to do, and that's primarily on your agent. So, who puts money here? A lot of people do. So do a lot of banks. So here's some banks that everyone has heard of. The largest we see is Bank of America. I've got to update this chart actually. They currently have more than $24.3 billion in the cash value holdings of their life insurance policies. What you'll find is that most banks put as much money as they are legally allowed to put into these products. The main reason why is for the cash value, although the death benefit does have some very significant value from a long-term perspective. The death benefit, if you look at Bank of America, their cash value is at $24 billion. The death benefit is going to be about 3 times that dollar amount. I'll explain how that works when I go over the bank that we work with. I'm going to show you their numbers. Corporations also put money here and have put money here for a long time. The 3 corporations I have up on the screen, I have them here for 2 reasons. The first reason, everybody knows who they are. The second reason, if you were to go back to the founders when they started these companies, you would learn that all 3 of the founders owned whole life insurance and they borrowed against the cash value of their policies to keep the businesses afloat. Wealthy families put a ton of money here. Now, the definition of a wealthy family is going to vary depending on who you speak with. For one family, it could be $1 million. For another, it could be $100 million when they consider themselves to be wealthy. What many wealthy families do is typically own policies on all of the family members. The cash value is typically accessed, the policies are owned by a trust in many cases. The cash value is accessed as their own family bank, if you want to call it that. So the family can use it whenever they want, however they want, but you typically have a board of family members, sometimes outside advisors that are approving the use of the cash value for business opportunities and family investments. But then you also have the death benefit on each family member. And when each family member passes, the death benefit is paid out 100% income tax-free. And what we see with a lot of the families we work with is that trust that owns the policy is also the beneficiary. So it receives that money income tax-free. And then the trust specifies how those tax-free proceeds should be used for the family. There's a lot more to that, but that's a high-level overview. So while those examples might sound cool, let's go through some of our actual clients. Earlier, I mentioned that one of our biggest clients is a bank. Here's the bank that we work with. So I started working with them in 2020, and they started with a $10 million deposit. In 2021, they made another $10 million deposit. And earlier this year, 2025, I met with the CEO and the chairman of the board, and the chairman asked, what are the rates on these products right now? I said, a little bit higher than 4.6%. He said, all right, that's a no-brainer. and they deposited another $5 million. So they deposited a total of $25 million thus far. Their cash value is greater than $29 million, and their death benefit proceeds are getting close to $66 million. Now, sometimes I get the question, how does that work? Life insurance on a bank, or say it's on a company, like who does it go on? The brick walls of the bank? I used to think that when I was brand new in the industry. It doesn't. So this particular bank has life insurance policies on about 30 of their employees. These are the top 30 employees at the company. The bank's not restricted to only putting it on the top employees, but that is most common. And how it works is when each employee passes, however much life insurance that employee has on their life is paid out income tax-free to guess who? The bank. That's not why the bank does it though. So earlier, when I mentioned that I met with the chairman of the board and the CEO, and he said, hey, it's a no-brainer to deposit another $5 million. Why he said that is because the cash value grows safely and it has a nice tax benefit. That's why. Next, we've got a hedge fund officer. So I'm not going to mention his name because some people might know who he is. He's been interviewed on some money channels over the years. One of the sharpest guys I have ever met. His processing speed is so quick when it comes to numbers and just the stock market and economy. He's worked for JP Morgan. They actually shipped him overseas to Hong Kong for 6 years to head one of their divisions. And he's also worked for Goldman Sachs and knows many of the executives there as well. His story, when we met, was that he had about $5 million sitting in a money market. Why he had that much cash there was to keep it liquid for opportunities. Now, his money market was earning between 4 to 5%, but it was taxable. He's also in the highest tax bracket, and he also lives in New York. He was interested in whole life insurance for the cash value because of the safety, similar to what he has with the money market. It's a safe place you could put money, but what he didn't get with the money market was the tax-free benefit, where he could access that cash value tax-free. So his specific plan is exactly what you see up on the screen, to fund a total of about $2 million over a 4-year period. He might continue to add money after the 4th year, but this is his current plan. The break-even point, which represents when his cash value exceeds his total payments, is the 4th year. And then we've got the annual yield. Not the dividend rate, by the way. Anytime you see a dividend rate with a life insurance company, it's never what your money's growing by. It's a gross rate. The annual yield represents the net growth rate. If we calculate what is the cash value growing year over year, peaks out at about 5.45%. Early years, it's negative in the first year. Keep that in mind. But the annual yield is really what he was attracted to. And he's a numbers guy. Here's what we looked at. The taxable equivalent yield. Here's what this column means. He would need to earn about 9% in a money market or a taxable account where I've got to pay taxes on the gains as income each year. And then after paying taxes in his 40% tax bracket, he'd be left over with about 5.4%. I'll just put it in a life insurance policy, he says, because I get that 5.4%, but I've got the tax benefit, and there's also no risk. He said this, when I compare cash value life insurance with other fixed assets at some of the top hedge funds in the world, he mentioned Citadel specifically, which is one of the larger hedge funds that specializes in fixed assets. He said the net results are about the same to me as a consumer. The difference, however, is I don't have high management fees that I'm going to have with a hedge fund, and there's no minimum $5 million buy-in. And then he said, it's a crime that more people don't understand this. Do you think he'd put money here if it was a bad idea? No way. Next, my friend Greg. So Greg's a real estate investor. He started his policy right around the time I got married. And these are his actual numbers, by the way. So you'll notice that this chart shows 2015 through 2025. So Greg was interested in a policy because he saw that the cash value grew safely. He really liked the tax benefit, but what he was mainly interested in was using this policy for real estate. And I've got to see him do this over the years. I remember 2 or 3 years in, he was using the cash value for a project he was working on with his son. It was a townhome, so it was pretty neat to see. Now, at this stage in his life, he's no longer making payments. Past 2 years, he's paid zero, and he does not plan on paying anything additional either. What I want to focus on, though, is 2020 through 2022. This was during the height of COVID, and interest rates were as low as I've ever seen them. They were bottomed out. His money's not tied to the market at all. He's earning just under 5% per year without any risk. This year, for 2025, he'll earn about 5.5% with no risk. And we have the tax benefit, which is so sweet. That comes out to about $56,000 in growth this year. Again, tax-free, provided we continue to follow IRS rules, which again is simple. People we work with typically own whole life insurance because it's a safe place for their money. They can access it anytime, and it's got a nice tax benefit. That's what most people express. If you ask them, why do you do this? It's safe, I can use my money anytime, and I like the tax benefit. Now, with all of that said, you can still mess it up.